Hey, it's Richard with Matthews Wealth Management. We're going to be talking about a very popular topic today. It's required minimum distributions. So we refer to them as RMDs in the industry. And typically, this is something that people don't think about until it's a little too late to do anything about. It becomes a reactive part of retirement. So the gist of this is it applies specifically to IRAs, or qualified dollars, tax qualified dollars, pre-tax, tax deferred. All of those terms are where we get into the world of required minimum distributions. And as the name implies, the IRS requires that you take a minimum distribution out of your IRAs or 401ks if you're no longer working at this age. So this year in the Secure Act, there was a change, a very large change that was made to RMDs. And specifically, it used to be at age 70 and a half that you were required to start taking a minimum distribution out of your IRA. And that changed this year. So if you were turning 70 and a half this year, don't worry about it. I mean, you should still worry about it, but do some planning instead of reacting later. The new age to start your required minimum distribution is at age 72. None of these factors changed. These factors we'll go through here in a second, but they're all based on a mortality table, actually. Uniform Lifetime Table 2 is what the IRS uses for these factors. So let's jump into it, and I'll go through a quick example just to kind of show how this works, what the consequences are of this minimum distribution rule. So I'm going to go with the old chart here, going from 70 and a half all the way to 95. So at whatever corresponding age, we have a factor, and that factor is based on a joint life expectancy. So there's actually a little twist to this factor table. If you and your spouse are further than 10 years apart, a different table applies. This is the majority table that we end up using. So in most examples, 27.4, it's kind of a joint life expectancy between the two spouses on an IRA. And then you can see that number drops over time. Obviously, y'all are jointly getting closer to the end of the road, and therefore those numbers are falling. Now, that may sound like a good thing. It's actually the opposite. We look at taking a amount in an IRA and dividing it by the factor, which means that our percentage of minimum withdrawal each year goes up. Okay, so we start at 3.65%. By the time we're 95, you have to take out 11.63% at a minimum of all of your IRAs. And if you've ever gone through like rule of thumb, how much can I withdraw from my IRA in retirement? You know, it's somewhere around 4.5%, maybe 5%. And you exceed that 5 at age 79, forced by the IRS. Now, what happens if you don't take out this minimum amount? Well, the IRS will come in and say you should have taken X amount out of your IRA. You didn't, so we will penalize you 50% of what you should have taken out. So do not miss these withdrawals. These are incredibly important. Your financial professional and your tax professional should be on top of this. They should be coordinating behind the scenes to make sure you don't pay a 50% penalty. It's the biggest penalty that we have. So very important to make sure you're taking out in the minimums here. So I want to run through a quick example here, and let's say that we have a typical scenario where somebody has retired and the majority of their savings is in an IRA, which is very usual here. And let's say that we've got a $100,000 that's over here in an IRA that is let's say it's in a variable annuity. Y'all know how I feel about variable annuities. They're not great. So, but let's say that they did that, and we're meeting them when they're turning 70 and they heard about this required minimum distribution rule that they have to follow. Let's say that they have another $250,000 401k that's still at their last employer that they retired from. And we'll throw another $150,000 in an IRA that is being managed by somebody. So we'll just call that a managed account. Okay. So what the IRS says is, all right, we've got 100, we've got 250, another 250 makes a total of 500, right? So we could just say we've got a $500,000 IRA value, and there's an actual technical term that the IRS is going to use to establish what is the total amount here. So we would look at what's called a fair market value. Okay, and that is published in a statement from every single one of your custodians that is holding IRA funds, and they have to notify the IRS what these numbers are. They have to send in separate filings when money transfers so the IRS knows where this money is and what that fair market value is for auditing purposes. So it's important you keep up with this. With clients at Matthews Wealth Management, we have a running fair market value chart that we provide to clients so that we can make sure we're not missing that. But in this instance, we have a total of 500 grand, and it's split up this way. We have those dollar signs. That's kind of a pet peeve of mine when I watch videos. But then how can we take the required minimum distributions? Well, one of the things that jumps out first and foremost is inside of a variable annuity, we're probably going to leave this thing alone because they probably bought insurance on it a long time ago, for a guaranteed minimum withdrawal rate or a guaranteed minimum death benefit or any of these crazy riders out there, and it doesn't make sense to cash it out and do some good money management with it. So if we end up taking money out of here, however, we may be exposed to invalidating those guarantees that we've been paying into. So it's important that we don't necessarily just start pulling out of every single account. But in this instance, let's run through and see if we did do that, what that would be. So 100 grand, and we're gonna say that this client is, we're gonna go 72, just so it's accurate. And today I'm used to doing this at 70 and a half, but let's say at 72, we've got our factor of 25.6. So in the calculator, we take 100,000 and then we do 25.6 divided. And that means that we owe, or we have to withdraw $3,906.25. And that is the RMD for this account. And you can take it in January 1, you can take it December 31st, as long as it is within the year, the tax year. This is the minimum that has to come out. So if somebody's taken, like $500 a month out of it, don't worry about it. They're going to have the $6,000 taken out. They'll exceed the minimum. They're fine. But if they're not drawing out of this, this is the required minimum distribution on this account. So for our managed account, we have 150,000, and we're going to divide it by that same 25.6, which says we have to withdraw $5,859.38. Always round up when you're paying the IRS. It's just safer to overpay a penny than to have to pay penalty and interest. So that's rounding up by half a cent. But so 3,900 here, 5,800 there. Lastly, our 401k. If we're still working, we don't have to do an RMD on this. But in our example, this person has retired. They just left their 401k behind. So we'll take that 250,000, divide it by the 25.6, and we have to take a minimum of $9,765.63. So that's the RMD on the 401k. So we can take each RMD separately, or we could take only from these two. As I mentioned, there might be a benefit that we don't want to void on a variable annuity, in which case we'll just split this $4,000 roughly between these two, as long as we are taking the total out of some mix of the accounts. That's all the IRS cares about. Why do you think they want you to take a certain amount out? Because all of this money counts as income, and you have to report that on your taxes, and you have to pay taxes on it. So there's a domino effect that tends to happen when we're looking at this. Let me just run the 500K real quick so that's out of the way. 25.6 there. We've got 19,000 $19,531.25 and 26 cents if we go with the roundup there. But $19,531 is income you have to take and pay taxes on for the year. So in a lot of cases with a lot of clients, they've built up a large enough nest egg, they have enough Social Security, their expenses are low because they've paid off all their debts, they live within their means, and all of a sudden they hit 72 now, and there's another 19 grand that has to come in and pay taxes on. Well, the domino effect is that Social Security, if they were comfortable on getting by with that Social Security, and we've got other videos out there about Social Security taxation, but you bring in another 19 grand of earned income from an IRA, now that Social Security that was not taxed at all is automatically 50% taxed. Or if it's already at 50%, it can grow up to 85% of that Social Security counting as income to be taxed. So not only are we paying taxes on this, now we're paying more taxes on our Social Security. And now what happens is we jump into a higher tax bracket. Maybe we're at the 10%, now we're in the 12 or the 22. So this has been in the back pocket of the IRS all along, and you usually don't find out about it until a friend or family member says, I've got to take these RMDs, do you know anything about it? And you realize, no, I don't know anything about it. So there are some strategies that we can start to implement at age 59 and a half to minimize this long-term consequence of how the RMDs affect your taxation in retirement, and it's worth a lot of tax savings. So we'll do some of those strategies down the road in some videos, but just wanted to give a quick overview as to what are required minimum distributions, or the term RMDs, to make sure you know what's coming at age 72. So get ahead of the curve, be proactive, not reactive, and join us down the road. We'll have some strategies for you.